So experts are calling for a pause on Federal Reserve interest rate hikes. Go figure, as wage growth rates slow. Here are the details, reporting from Common Dreams. According to the new figures released by the US Labor Department, wages grew at a slower than expected rate of 0.3% last month. And November's hourly earnings number was revised down from 0.6% to 0.4%. Job growth, meanwhile, remained strong in December, even as it cooled compared to the torrid pace of early 2022. The Bureau of Labor Statistics said the United States added a better than anticipated 223,000 jobs in the last month of 2022, the fifth consecutive month of slowing growth. Inflation overall has cooled a little bit more than initially expected. So the Bureau of Labor Statistics said that the consumer price index rose just 0.1% in November compared to a 0.4% increase in October as inflationary pressures eased across the economy. From food to transportation to medical services, compared to a year ago, inflation was up 7.1% in November, the lowest level since December 2021. However, the Fed is not convinced that interest rate hikes are not the solution, despite this data. The new jobs data comes days after the Fed released the minutes of its mid-December meeting, after which the central bank raised interest rates to their highest level in 15 years, despite growing warnings from a range of experts about the potential for a damaging recession and mass layoffs. According to the minutes, Fed officials are not yet satisfied with the evidence showing that inflation is slowing significantly and intend to stay the course with higher rates. Central bankers also suggested they believe the labor market is still too tight and wage growth is too strong, reiterating their goal of bringing down the latter, even as they admitted there are few signs of adverse wage price dynamics. So, with slowing wage growth and increasing prices, the average workers in the United States are struggling to keep food on the table and pay their bills and pay rent, all while CEOs of corporations are raking in record profits. If the CEOs and corporations are seeing that they're experiencing record profits, that means that they have raised prices for more than necessary to account from disturbances in their supply chain that they experienced during the pandemic. They would not be seeing record profits if they had only raised prices proportionally to cover for that instability. That's very simple. In July, the AFL-CIO released a report on top executive pay. They determined that CEOs, not working people, are causing inflation. Titled Greedflation, the report shows that in 2021, CEOs of S&P 500 companies received on average $18.3 million in total compensation. CEO pay rose 18.2% faster than the United States inflation rate of 7.1%, the analysis finds. In contrast, US workers' wages fell behind inflation, with workers' wages rising only 4.7% in 2021. The average S&P 500 company CEO to worker pay ratio was 324 to 1. So while the right and Tucker Carlson will run programming about the crisis of workers' needs not being addressed in the United States of America, for some reason the solution is to never regulate those corporations and to have someone actually do something about the greed that's being exhibited by the people who are running our economy. And so that's why we here at TYT cover stories like this, because you don't see mainstream press covering stuff like this. It's incredibly important for someone to fight for the workers. All the while, we see intense union busting happening at the hands of these corporations, and people like Joe Biden even forcing workers into predatory contracts, thinking of the rail workers recently. And so when it comes to labor, it seems that no one in American politics is on the side of the workers, and this is the consequence. Francesca?
Yeah. No, you're absolutely right. I mean, look, there's some glimmers of hope in this administration. The rules around non-competition requirements for employers and how those are being done away with from the federal level, that's incredible. That will help workers be able to negotiate their wages and their salaries in the future. But this is key. This story is the story, which is that this administration has decided that workers are the ones who are going to pay for inflation. That's it, period. It won't be corporations, it won't be owners of business, it will be people who are already squeezed as it is. That's why inflation rates are coming down on us. Oh, you wanted to own a home? Never. You're never gonna own a home. It was already impossible. Now it's completely impossible, right? So this has been done before. It's called a price freeze and a wage freeze. If you're afraid that wages are too high, which they're not, and you just saw the evidence, but if you are somehow afraid, well then guess what? The fat cats at the top should also have to pay. You can freeze wages if you think they're too high, but you should also freeze prices. That way people don't get gouged on either side, right? They're trying to take a bite of everything we've got, right? And so, but no, this administration's not interested in that. They're not interested in doing something that would help everyone and also hurt everyone just a little bit. Everyone would have to pay. They're only concerned with, honestly, making the working class bear the brunt of it. And it needs to be talked about more. Because at the end of the day, Jerome Powell is exactly doing that. He's like, sorry, y'all, the majority are gonna pay. The 1%, they get off.
Yes, the CEOs and the corporation owners will always be the ones winning when it comes to how the economy is structured in the United States. And that goes for big pharma as well, of course, naturally.